This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So having dealt with bad relief, let's have a look at investors' relief, because it extends the bad relief now to external investors in trading companies. The limit, as we saw earlier, is £10 million lifetime, and again taxed at 10%. This is in the rates. Make sure that you check the rates every time, never guess. So in order to get this quite generous benefit of having to pay tax at the very lowest rate, there are some conditions, and these are the conditions. They must have been subscribed for before the 17th of March 2016 and held for a minimum of 3 years. Unlike business asset disposal, there is no minimum level of shareholdership required, and you must not have been an employee or a director, which is different obviously from bad relief. So let's have a look at example number 3 of how this works. A simple example, simply because it doesn't turn up as much as the bad relief. Bad relief is more likely to turn up in the exam. This is less likely to do so. So we have an example here of how that works. 20th of October, Ashley sold, be careful here, this is where you have to read the question carefully, 30,000 shares. Unquoted, it's a trading company, for 375 net of expenses of 10,000. So that's already been deducted. Okay, so it's 375 net of those expenses. Now there is £1 million worth of shares in issue. They are at par. That means face value. It's after the deadline date, and she bought 40,000 shares and she's never worked there. So clearly she fulfills all the conditions for investors' relief. She has taxable income of 60,000, so she's high rate, and other asset disposals with a gain of 7,000. So how does that look in reality in a pro forma? Let's have a look. So we have the sales proceeds of 375,000 per the question, less cost. Now this is where you have to read the question carefully. She sold 30,000 shares out of a holding of 40,000 shares, and the cost was £40,000, which means that we have an allowable cost against the sale of these shares of £30,000, giving us a gain, proceeds less cost equals gain. In all situations, make sure you do that. The gain is therefore 345,000. Now, there's no AEA because the question said that she had used that against the other gain. So this gain, 345,000, will be taxable at 10% because of investors' relief, because it fulfills all the conditions. Okay, back to the notes then. Rollover relief. This is the examiner's favourite relief, so we need to know this very, very carefully. Again, there are conditions that need to be fulfilled, and then from there you will have benefits as a result. And as I said, this is the only one that is available for limited companies. So it's called rollover relief because you basically roll over or defer or put off, postpone, whatever you like to call it. It's called deferred. That's the technical term, so I would prefer it if you use that, but obviously that explains what it is. Now, it has to be a disposal of a qualifying business asset where the sales proceeds are reinvested, not the gain, the sale proceeds, in another qualifying business asset. So what are qualifying business assets? These are the ones that you're going to come across. Now, both of the old asset and the new asset must fall in this category, and both the old and the new must be used in the business in full. So we're probably looking at buildings being sold, buildings being bought. The purpose of this rollover is to allow a business, so say you have a factory, you are a business and you've got a factory and you want to expand your business, and this factory isn't big enough. So you want to sell it and buy a bigger one. Now, the tax bill on that proceeds less cost equals gain, you're not going to get bad relief because it's only part of the business and it's not capable of working on its own. The tax bill on that could be huge, so big that you don't actually have the cash to be able to pay the tax man the tax for this. So what they are allowing you to do is to roll that gain into the cost of the new building. You don't have to pay the tax at the point, which means you can then afford to buy the new building because you've got to reinvest all the proceeds. And having done that, you don't have to then pay the tax until the next time you either sell that building or you can roll it again. You can continue to roll and roll and roll. So the relief, I've kind of explained some of this already, but let's just go through the relief. So the gain is not taxed immediately, but postponed until you either dispose of the replacement asset and don't replace that again. The postponement is achieved by deducting the gain made on the old asset from the cost of the new one. That will then give you what's known as a base cost, where the disposal proceeds of the old asset are not fully invested. The surplus reduces the amount of gain that can be rolled over, and then you will have to pay tax on that. So roll it all over, no cash because you've used every penny, no tax. If you roll it over and you have some cash left over, and I'll explain that again later with some diagrams, if you've got cash left over, you will have to pay the tax on it. There is a time window, 12 months before, 36 months afterwards. You can have it on the sale of an individual asset, okay, which is when bad relief won't be able to be available, and you've got to make a claim. So it's 4 years from the end of the tax year. So that's the date you would have to make that claim. So let's have a look at example number 4. Before I do, just want to reiterate that at the bottom. Full rollover relief is only available when all the net proceeds from the sale of the old asset are reinvested in a qualifying asset. So you're looking for several things when you go through a question. So Jones bought a property to use in his business in March 2008. That was the cost of that business. In August 23, he sold it for $300,000. Okay, so it was a business asset. We know what the cost is. Now, in August 23, when he sold it, he then spent more. So he reinvested all the proceeds in June 23 in a new business property. It fulfills the obligations. It is a business asset. They're both used in the business. He did it. Let's just check the timings. He sold that in August and he bought that one before, which is 2 months before. So yes, he fulfills the criteria. So as you're reading the question, you're looking for proceeds less cost equals gain, and your mind should be thinking, has he fulfilled all the conditions that are available for this? So let me show you how that looks on a pro forma. Just want to kind of explain it to you. So if we were just doing proceeds less cost equals gain, and that at the end of the day is what's important. If you can't remember to do rollover, always do proceeds less cost oops, there's a note in there, equals gain. So if we do nothing, he will pay tax on that business asset. But what he's going to do, he's going to roll it over. So it cost him 250,000, yep, and he sold it, the proceeds were 300,000, and he made a gain of 50,000. Now that proceeds has to be reinvested, and it was reinvested in a property, whoops, for 320,000. So that gain is then rolled over into that, and we don't pay tax. We claim rollover relief in full, and he does not pay tax. At this time it is deferred. Okay, so the consequences are we now have a gain of 50,000 rolled over into here, which means the base cost of this asset is 270,000. Now say for example in the future he decides he's going to sell this for say 420,000. He's not going to replace it, 420. If we only deal in property 2 in isolation, it would be proceeds less cost equals gain. Yep. However, it isn't, because he's rolled this over and he has to pay tax. Although it's been deferred, he still has to pay tax because he's sold property number 2 and he hasn't reinvested the money. So the proceeds obviously is the same, but we use the base cost figure, 270,000, which gives us 150,000 is now taxable. So that is the 100,000 on the rise of the building and the 50,000 gain on property 1. So effectively he's paying that in full. So let's go back to the notes and look what happens if only part of the proceeds are reinvested. So if that is the case, if it's only part of it, then this is the rule that relates to that. The amount chargeable is the lower of the amount not reinvested, which is normally the case, or the full gain. So we're going to have a look at example number 5. So Jerome bought a factory in June 2006 for 680,000. In August 23, wishing to move to a more convenient location, he sold it for 800,000. So proceeds less cost equals gain every single time. Proceeds less cost equals gain. He moved into a rented factory until January 2024 when he purchased and moved into a new factory. It's within the time span. Both of them are factories that are used in the business and both of them are qualifying assets. So we're going to get rollover relief. It says the requirement, assume that all beneficial claims are made, which is rollover relief. Calculate the base cost of the new factory if A, it was bought for 750 and B, if it was bought for 600,000. Okay, so let's have a look at how that would look in the model answer, because obviously we can do proceeds less cost equals gain and we need to see how that works. So let's have a look at the model answer. So the A part said that they bought the new factory for £750. This means that £50,000 of the sale proceeds has not been reinvested. So the rollover relief calculation means that it's the lower the amount chargeable is the lower of the full gain or the amount not reinvested, and this is the A part is where it's not the lower of the two is the amount not reinvested. So we do this down. Sometimes when you do calculations, you do down and then up again. So you would do that down as we did in the we wrote in the question. We know that that is the amount that was not reinvested. So we can actually put that in the answer. Okay. And we would obviously show in the exam question how we come to that figure, because it's 800,000, which was the proceeds, less what he bought it for. So that's obviously 50,000, which means that this is the balancing figure that you can then claim for rollover, which would then be deducted from the cost, the 800,000, to work out the base cost. Now, this is the other alternative. So this model answer here gives you both alternatives, which helps you to see how that works in both cases. So we've bought the factory but only spent 600,000. We have kept 200,000. So proceeds less cost is gain. We can't have any rollover relief because this figure would be 200,000. Therefore, there's no rollover relief, and they simply pay tax on the gain, as it were, and that's how that works. So one last section under rollover relief is where there is non-business use. So full rollover relief is only available where the asset being replaced, the old asset, is used entirely for business purposes throughout the ownership period. Where this condition is not met, then rollover relief is limited to the business proportion. Use your common sense to work that out. Okay. Assets are treated as two separate assets. One qualifies for the relief and the other doesn't. Okay, so let's have a look at Jake. He bought a factory in May 2015 for £540,000, which he used in his trade, but he let out 15% of it. And in July 2023, he sold it for 600,000. So here already we have proceeds less cost. We have a gain of 60,000. What is the chargeable gain arising on the disposal in July 2023? Okay, now it says there he bought a new factory for 650,000 and claimed rollover relief. So while he actually invested all the proceeds, this is the problem that we have here. So we're only entitled to a percentage of rollover relief. Taxable. So £60,000 times 15% is £9,000, and that is what he has to pay tax on, which means this again is a balancing figure of 51,000, making the base cost of the building 650 minus the 51, which is 599.